Well, welcome everyone to tonight's webinar, Taxes for Domestic Nonprofit Corporations and 501c3s. My name is Nancy Champlin, and I use she and her pronoun. I'm the Executive Director at Southeast Uplift. And for those of you who might be new to Southeast Uplift, we collaborate with the Southeast Portland community to build informed, inclusive, and participatory neighborhoods that support our social and ecological well-being. We also joyfully support Northeast neighborhoods that are south of I-84. Here at Southeast Uplift, we envision a more resilient future for our communities where everyone feels and is welcome, interconnected, and empowered with the resources needed to advocate for change on the issues that impact their lives. Before I jump in, just want to and introduce you to our guests, our experts that are here in the room with us. Just a few housekeeping notes. As you know, this webinar is being recorded. The closed captioning is on. All registrants will receive a copy with a link to this recording once it's posted to our YouTube channel. Thank you in advance for your patience as we get that uploaded. If you have a question during tonight's presentation, feel free to raise your hand or use the raised hand emoji at any time. You don't have to wait to the end. If you submitted a question when you registered, we have shared them with our speakers. And at the end, like if your question isn't answered through the course of this training, then feel free to put it in the chat or we'll just go straight to those questions. We want to make sure that if folks submitted something but they're not here to ask the question, we'll make sure that it gets asked. We've allotted a generous 2 hours to this training, so please don't be shy about letting us know when you have a question. And before we get started, just was hoping to do just a quick raise your hand if you're here to learn about taxes for domestic nonprofit corporations. Great. And then if you're here to learn about taxes for 501c3 tax-exempt corporations. Great. We've got like about a 50-50 split, so that's great. Well, we're going to cover both. And without further ado, I'm pleased to turn things over in just a sec and introduce you to tonight's trainers. They're both from McDonald Jacobs, which is the accounting firm that does Southeast Uplift's taxes, and we're very grateful for that. Speaker Sang On has been a CPA or certified public accountant for 25 years. He has a bachelor's in science and business administration and accounting from Hawaii Pacific University in Honolulu, and a master's in financial analysis from Portland State. His current and past community involvement includes Vibrant Village Foundation, Beaverton School District Audit Committee, Dove Lewis's Finance Committee, and Portland State University's Accounting Advisory Board. Sang specializes in nonprofits, professional services, and individuals. And then there's Blaine Bradford. Blaine has been, sorry, in public accounting for 7 years. He has a bachelor's of science in business administration and accounting from Warner Pacific University and specializes in working with nonprofits, multi-state entities, and professional services. Sang and Blaine, welcome, and over to you.
Thank you so much, Nancy. I'm going to go ahead and bring up our presentation here. Unfortunately, the CPA exam doesn't include anything with Zoom. So can everybody see this okay? Nancy, is this showing up all right?
Yes, I can see it.
Perfect.
Yumunga, do you have a question before we get started?
No, nope. Sorry.
Oh, okay. Okay, great. Just wanted to check.
All right. So today we're going to talk about, as Nancy said, both tax-exempt organizations as well as nonprofit corporations that have yet to apply or receive 501c3 status. So just to kind of cover those two terms a little bit, when we refer to nonprofit organizations, we're typically referring to the legal structure that's provided by the state in which the organization incorporates. And so while you can be a nonprofit corporation, that does not automatically give you tax-exempt status in the eyes of the IRS or state organizations. So on the other side, a tax-exempt organization, typically we're referring to 501c3 or other 501c organization as designated by the IRS. So we'll cover kind of both of those a little bit today and some of the differences between them. The first thing we want to talk about is just kind of the underlying entity structure and laws that govern both tax-exempt organizations and just nonprofit corporations in general. We'll talk about the tax exemption and application process a little bit, what that looks like, what's involved, and what it means for your organization to become a 501c3 in its own right. We'll talk about the tax filings that go along with being a 501c3 and or another type of exempt organization, and just kind of briefly cover what some of those other types of exempt organizations are, because we all hear 501c3 so often, but there are some others as well. We'll talk a little bit about public support. It's an area about being a 501c3 that's not often covered, but is very, very important to consider if you're looking at becoming a 501c3 organization. We'll talk about lobbying and political activities and kind of the do's and don'ts of those. And then last but not least, we'll talk about unrelated business income tax, which is always the scary term UBIT that you hear with 501c3s. We'll talk about some common scenarios with UBIT, when nonprofits and tax-exempt organizations might have to pay tax, and kind of what those scenarios look like. So to start off, just talking about the entity structure of nonprofit corporations. So just like any kind of corporation that's formed, a nonprofit corporation in Oregon, the first thing to do is decide the name of the organization. You're also going to have a couple different options for entity choices. So a nonprofit corporation is one. That's a status designated by the Oregon Secretary of State. But you can also become a tax-exempt organization if you're a trust, if you're an association, and so not really a formalized corporation. Or there's kind of some other designations as well that we won't really cover, like governmental organizations. The state of domicile is also an important distinction. We're just going to talk about Oregon nonprofits today, but there are different rules that govern each state. And so if you're in another state, it's important to consider that those rules may be different. And then just note, like we said, nonprofit corporations are not the same automatically as tax-exempt organizations. And so while a nonprofit corporation can become a 501c3 designated organization through application, just because you receive nonprofit corporation status from the state of Oregon does not give you 501c3 status. We'll talk about that a little bit later. So Oregon nonprofits, you start by registering with the Secretary of State and filing articles of incorporation, then submitting bylaws that kind of tell the state of Oregon how your organization will be governed, the makeup of its board, and so on, and then registering with the Oregon Department of Justice. And the Oregon Department of Justice governs and monitors all charitable organizations within the state. And so there's a couple different things that you can kind of classify yourself as when registering with them. So if you register with the Secretary of State and decide that you're going to be a public benefit corporation in the state of Oregon, that means you're going to be governed by the Oregon Department of Justice and subject to their reporting as well. Public benefit corporations are the most common types of nonprofit corporations that we typically see. And so that's going to be things like your community service organizations, your housing organizations, all of the common kind of 501c3s. You also, though, have mutual benefit corporations within Oregon. And those are things that are more like organizations that are created to benefit their members. So you might see things like trade associations, maybe social clubs, those kind of things that aren't really organized for a public benefit, but are still potentially tax-exempt organizations. So we're going to look primarily at public benefit corporations, but just know there are some other options out there. And then the number of directors, there are rules regarding this. Oregon, for public benefit corporations, Oregon actually requires now that you have 2 directors that both hold different positions. We'll cover that makeup in just a second. But other types of nonprofit corporations could potentially have fewer directors. So we'll look at that in the next slide. So corporate officers, this is going to be things like your executive director, your finance director. These are generally employees of the organization, although they may or may not receive pay. So you could be a volunteer executive director as well. Board officers, on the other hand, these are going to be the organization's board members that hold positions that kind of govern and manage the organization. And so you're going to have the president, the vice president, the treasurer, and the secretary. Those are the most common. Board officers really are the ones that kind of hold the legal responsibility for the actions of the organization. So board members, while Oregon does offer some protection for volunteer board members, there is a sense of legal responsibility and duty that comes with being a board member. If anybody's curious, the Oregon Department of Justice actually does have a really interesting guide that they publish for new-time board members, and it covers kind of the responsibilities, the legal duties that you assume by being in that position, and what to kind of expect in that role. So that's a good resource. And then note, the president, treasurer, and secretary, those positions are required by Oregon statute. And so while an individual can hold more than one of those offices, Oregon does not allow one individual to hold all three of those positions. So they want those to be kind of broken up between two people in some way, hence the two board person minimum requirement. So looking at the kind of some other common types of entity structures, again, we'll just briefly look at this, but there are a couple other types. You can have affiliates. This is typically where you have kind of a larger national organization, and then they might have some smaller organizations, which are technically different organizations in their own right, but which they kind of directly control. And then religious organizations, those are going to be things like churches or mission-related organizations that are strongly related to a church or other religious organization. Those have a little bit different rules. And so we won't really cover too much in that, but those are also potentially nonprofit organizations in their own right. So filings for nonprofit corporations, it's important to know that just like other businesses and corporations, nonprofit corporations still have the same information filing requirements as other organizations do. This is the same for nonprofit corporations, both with and without 501c3 status. So information returns like 1099s and W-2s, those still have the same rules that other organizations would have, which is that 1099s need to be given to non-employees that receive 600 or more during the year, unless there's another exception that applies to that reporting. So you would want to kind of reach out to each of those people and receive a W-9 from them telling you whether or not they need to be issued a 1099. And then W-2s, of course, must also be given to employees, just the same as any other corporation. So those are still filings that all organizations have to do. And then it's also worth noting that nonprofit corporations, they're going to be subject to the same filings as a regular corporation would, unless they receive exempt status under the IRS, or unless they're being sponsored by another 501c3 organization, what's called a fiscal sponsorship. So yeah, that's where Southeast Uplift comes in, right? So they kind of shelter you from some of those reporting requirements. But barring that, or, assuming that you're not within that kind of a relationship, a regular corporation that's conducting activities just as a nonprofit corporation, you're essentially just saying we're a corporation that's organized for the purpose, not for the purpose of making a profit. But that doesn't really affect Oregon or the federal government's perception of your taxability and even the state of, or the city of Portland, rather. So each one of those organizations sort of says, well, if the IRS has determined that you're exempt, we as Oregon will say you're also exempt. And then the city of Portland will say, well, if Oregon says you're exempt, we're going to follow them and also say you're exempt. So really, that federal exempt status is the one that you need to go after if you're looking to become an exempt organization at all levels in your own right. Or for other organizations where maybe that's not the goal, maybe you don't necessarily have the infrastructure in hand to manage your own exemption, fiscal sponsorship is a great way to go. So now we're going to talk a little bit about tax exemption. I've kind of talked about what it looks like to be a nonprofit corporation without exemption, and Sang's going to talk a little bit about what it looks like to go through the exemption process and what filing requirements come from that.
Thanks, Blaine. Nancy, should we take a pause here and take some questions, or there you go.
Yeah, I raised my hand to suggest that we do that and see if there's any. Yeah, that'd be great. Does anyone have a question? If you have a we're a small group, so if you have a question, just feel free to jump in, introduce yourself, and then jump right in. Go ahead, Stephanie.
Okay, so thank you very much. Earlier, the presenter Blaine referred to a document that is published by the state of Oregon that explains responsibilities for directors. Could you describe that again? I'd like to get it, but
yeah. So this is it's a guide that the Oregon Department of Justice puts out, and it just kind of covers recommendations for new board members of nonprofit corporations. So it talks about your legal responsibilities, just sort of the different things you should expect as a director in terms of your duty to the organization. Why don't I'll find that. I was just looking at it earlier today, and I can send it to Nancy. Nancy, would you mind distributing that to folks?
I'm going to drop the link in the chat right now.
Blaine, on our last PowerPoint slide, we have links to some useful, and DOJ is one of them.
Yes, but that is the one Nancy's linked is the one that I was referring to. Okay. Yes. So thank you so much, Nancy.
Okay, thank you very much.
Yeah.
Any other questions? And I believe actually, Stephanie, that there may be a hard copy in your mailbox at Southeast Uplift. I noticed that Machi delivered some goodies to some mailboxes, so there might be a hard copy there for you.
Okay, thanks. All right. So I've managed to get myself out of the meeting. I can hear you all.
But we can still hear you.
Yeah. I know, but I can't see you. Well, it's my struggle. You just keep going.
Okay, should we move forward, Nancy? Okay, well, thank you, folks, and it's nice meeting you, and thank you for having us here. I'm going to go over tax exempt status as well as application and filing requirements for those who obtain tax exempt status from the Internal Revenue Service. And tax exemption is granted under tax law, which is found in Internal Revenue Code section 501A. And that's where the code section starts about regarding tax exempt organizations, and it goes all the way through code section 527 or 8. Anyway, on the very first one, under 501A, we have a sentence there from the actual code section. It says, an organization described in subsection C, 501C or 501B, or section 401A shall be exempt from taxation. And 401 has to do with retirement plans, which we're not going to talk about. 501B is very special set of tax exempt organizations, which we're not going to talk about because we haven't seen one 501D organization, but we're going to talk about some 501C organizations. With that, Blaine, can you go to the next slide?
Okay, yeah. There we go.
Okay. So I'll talk about obtaining tax exempt status process later, but just because you obtain tax exempt status does not mean you are exempt from
this meeting is being recorded.
Sorry.
All other taxes. So the only thing that the tax exempt organization are exempt from is corporate income tax. Even then, some organizations, which Blaine will cover later, have taxable income called unrelated business income. So you have to keep in mind that the only thing that you're exempt from is federal corporate income tax. That's the only thing that you are automatically exempt from. All the other taxes that we have listed there, payroll taxes, property tax, sales tax, we don't see sales tax in Oregon, but other states, they do have that, and use tax and local business tax, you are still subject to them. In some cases, you have to apply for a separate tax exemption for those taxes. But the federal unemployment tax are also 501c3 organizations are also exempt from federal unemployment tax. Sorry, I don't have it listed there. And also climate payroll tax, you're exempt, but if you're a 501c3. One thing you have to keep in mind, though, your payroll company or payroll processor does not automatically know that you are 501c3. So you have to make a point of letting them know that you are 501c3. And you may even have to provide them with the what's called a letter of determination letter from the IRS to show that you're 501c3 so you can be set up properly in their system. Otherwise, you may be paying some unnecessary payroll taxes. So payroll taxes you do have to pay. Property tax, all those things that you use in your business or daily business activities like computers, desks, furniture, and things like that are called personal property. I know it sounds funny because it's not personal, it's business property, but they're called personal property. Counties can tax you on the value of your personal property unless you file for a separate exemption with the county. So you'll have to go to the county's website or the state's website and download a property tax exemption form if you are 501c3. If you're not 501c3, you cannot get exemption from the property tax. But they do have a form that you have to fill out, and you have to renew. Technically, you're supposed to file it every year, letting them know that you don't have anything new or anything to report. But you do have to initially apply for a property tax exemption with the state.
In saying, what about fiscally sponsored organizations? Do they retain the same exemption as their fiscal sponsor would?
No, it would go through the fiscal sponsor because fiscal sponsor would have the tax ID number that pretty much controls all the filings, which we'll talk about later. Good question. Can you move on to the next?
Yeah, and just real quick on this one, I just wanted to mention local business tax down there at the bottom. For us in Portland, that's the Portland business tax. We mentioned earlier that this is you're exempt from this as a 501c3 organization because the city says they're going to follow the state and the state says they're going to follow the feds, except for the UBIT stuff that Sang mentioned, which we'll talk about later. But one thing I wanted to bring up is a couple years ago, I think it was 2022, the city of Portland changed the way that they do their registration. And so they had previously had most tax exempt organizations listed there as tax exempt. But for some reason, when they updated their software, this no longer was the case. And so many of our clients were getting letters from the city of Portland saying, hey, we see that you're a business, but you're not paying taxes. And a lot of them were very confused by that. Most likely, if you're a fiscal sponsored organization, you're probably not going to get one of those letters. But if you are fiscally sponsored or if you are a tax exempt organization in your own right, you're still not liable for that tax. The city just needs to know that you have that status. And so you really just need to reach out to them with support showing that you're one of those. And they'll they're very friendly over there. You can give them a call and they'll update their system and stop sending you those nasty letters. So just wanted to mention that in case folks are seeing that still. I know for a while we were getting tons of phone calls on that, and the letters can be a little scary. So
Okay, I'm not sure how many of you are interested in this, but there are over 35 different code sections that grant tax exemption. I know there's about eight of them listed there that we deal with on a daily basis, but we're talking about 501c3 only today. But just know that there are other types of tax exempt organizations. Okay, we don't really need to spend time on this. Yeah, let's move on.
There will be a quiz at the end, so make sure you remember all these.
Yeah. So filing requirements. I think there are a lot of questions about filing requirements. So first of all, before you are required to file, you must have a tax exempt status. If you don't have tax exempt status, even if you want to file, you cannot file these 990 related forms. So we're talking, assuming that you have tax exempt status, whether you're 501C1 or C3 or C5, you follow these rules when it comes to filing 990s. 990 related forms. So 990N is if your average gross receipts. Gross receipts are different than gross income or gross revenue. So smaller organizations, usually gross receipts mean gross income or gross revenue, but larger organizations where they have investment income and things like that, gross receipts are slightly different than gross income. Gross receipts really mean all the cash you took in. Whether it's income or not, all the cash you took in would be gross receipts. When your gross receipts or average gross receipts are less than 50,000, then you can file 990N. Okay, and when your gross receipts are over 50,000 and under 200,000, then you file what's called 990EZ, and it's only 4-page form, but it usually requires 2 additional schedules. Schedule A, public support, which Blaine will talk about later, and Schedule B, list of contributors. The donors that donated more than 5,000 or more, they need to be reported on Schedule B with 990EZ. And if your gross receipts are more than 200,000 or your total assets are more than 500,000, then you have to file 990, the regular 990. And as you know, 990 has 12-page, is a 12-page form with potentially 16 different schedules. So it's pretty involved form, and it takes quite a bit of work to get everything right because the form requires financial information as well as non-financial information to be reported. Okay, 990T is not something I'll talk about, but Blaine might cover later. This is only if organization has unrelated business income of over $1,000, then you are required to file 990T. And it looks like corporate income tax, 990T is. And if you are required to file 990T, then you have to file Oregon 20. This is Oregon's version of corporate income tax. So even if you have loss from your unrelated business income, you are required to file Oregon 20 and pay $150 of minimum tax. And if you are required to file Oregon 20 because you have unrelated business income and you're in the city and county jurisdiction, then you are required to file city and county business tax. Okay, so these are just tax forms we just talked about. And for some reason, we did not list Oregon CT12. So Oregon CT12 is form that you file, and Oregon CT12 has no threshold. Even if you have zero income, you have to file CT12 with Oregon Department of Justice. And technically, you are supposed to fill out 990 to attach to CT12, even if you are not required to file 990. So what we usually do and what DOJ, Department of Justice, allows us to do is instead of fill out a whole 990 to attach to CT12, we do a simple letter saying, hey, this organization has less than 50,000 in income. These are the assets they have. These are the liabilities they have. And they usually take that over just 990 or 990 easy just to be attached to CT12. But CT12 must be filed even if your income is zero. Okay. Form 940 and 941s are federal payroll tax forms, and typically your payroll processor will prepare and file them on your behalf. Form OQ and WR are Oregon payroll tax forms, and again, the payroll processor will take care of that for you. Well, you have to make sure that your contract with the payroll processor has these provisions in there. Otherwise, they're going to assume that somebody else is doing it. So make sure if you're hiring a payroll processor, I think big ones like ADP and Paychex, they automatically assume that they'll do it. But smaller ones, we don't know for sure. So you want to make sure that they will be doing the preparing and the filing of these various payroll tax forms. Okay, and also when you're 501c3, you are required to issue a thank you letter to your donors, not just to be nice, but you are required by law, if your donation is more than $250, you have to send them a letter saying that, well, provide your federal tax ID number, let them know that you're 501c3, and also that donor did not receive any goods or services for their donation. Otherwise, the donor cannot take the deduction on their personal income tax. So donor acknowledgement letter is very important. And we have a publication, IRS publication at the end of this PowerPoint that has reference to the IRS publication that talks about the donor thank you letters also.
Nancy, did you have something?
Yeah, I noticed that Bing had his hand up, and
sorry.
and then I thought, I see that Bing has his hand up, and then after Bing asks his questions, this might be a great time to go to the questions that were submitted with registration, because they are all about filing requirements. So I suspect, Bing, you're going to ask the one that you submitted, so go right ahead.
Well, I'm going back to your CT12 filing requirements, and I've been doing that since, I think, 1997 for Mount Tabor Neighborhood Association. I've never filed a 990, and I've never been asked to have a letter attached to it.
So, neighborhood association, is it a separate is it a tax exempt organization?
We're tax exempt under Southeast Uplift.
And you've been filing a separate CT12 on your own?
Yes, we're required to.
That I did not know.
CT12 and the Secretary of State's annual report we have to file, and we get reimbursed from Southeast Uplift for the fees. But
right, a Secretary of State would be for registering and using the organization's name in the state as a business, but I did not know CT12 was required.
I think the CT12 requirement saying, I think it follows the public benefit corporation status. So I think if you're a public benefit corporation, regardless of your exempt status, you're under the DOJ.
This is a good question. Thanks, Bing. And Bing, so you don't have a federal tax ID number though, your entity.
When I took over as treasurer, there was one given to me as part of the treasurer stuff, and setting up and having a bank account requires that. And interesting that last year the bank was taking a withholding for federal tax, which was only a few cents a month, but then they stopped this year.
So domestic nonprofit corporations, as I understand, you can go through a processing and get a tax ID number, but that is not make you tax exempt. So, so technically Mount Tabor Neighborhood Association is not tax exempt. They get their fiscal, we are their fiscal sponsor. So, so I think Bing, one question you also had was if you need to file an IRS 990N.
Well, if you're 990N, if you don't have federal tax exemption, you cannot file even if you wanted to. So, yeah, the system just would not allow you to file if it doesn't match their database. So, if your entity has a federal tax ID number and there's no tax exemption, I think you're required to file federal corporate income tax.
It might be, Bing, we should talk offline.
Yes.
It may be Southeast Uplifts, but I know that groups can get their own tax ID number. It should so we can talk about that offline.
Yeah, I can talk to I can participate on that call as well.
Sure.
Yeah.
So,
And then there's yeah.
Oh, I was going to say, Bing, did you have your questions answered? Otherwise, I can move on. There were a few others around filing requirements that were submitted, and so we can cover them because I'm not sure that everybody that submitted a question had a chance to be here in person on the call. So that way they can listen to the recording and hear the answer. Let's see. One question was, when do nonprofits need to file Form OR 20? And a follow-up to that is, if a nonprofit is not tax exempt, do they need to file a 990 with the IRS? I think we just said no to that. So when do nonprofits need to file Oregon 20 form?
Oregon 20 is required if non-tax exempt has 990T, but nonprofit organizations would have to file Oregon 20 if they have taxable income. So since they don't have tax exempt status and all of their income will be taxable by the feds also to Oregon. So in that case, you'll have to file 1120 C Corp tax return as well as Oregon 20 corporate tax return.
And is there a threshold of dollar amount?
C Corp has no threshold.
Yeah, that's also assuming you're not fiscally sponsored.
Sponsored.
So,
right.
Yeah,
yes.
If you're fiscally sponsored, you're essentially exempt under another organization.
So I think there might be some confusion on my part also. If you have a fiscally sponsored organization that have their own tax ID, but they're not reporting or receiving any money or reporting any expenses under the tax ID, really those tax ID numbers would not have any business transactions because everything will be reported under as a uplift.
Right. So if a neighborhood association isn't tax exempt, they're fiscally sponsored by Southeast Uplift, any charitable contributions to them, whether it's a grant or a donation from an individual that wants to get a tax write-off, or like a business sponsorship if they contribute to an event or something, all of that has to go through Southeast Uplift because we're the tax exempt entity. However, if someone, puts out a jar for donations at a community event and folks put a few dollars in it and they're not expecting a tax write-off, they're just making that is just a gift. They can put that in their own bank account, but then if they reach a threshold, are they then subject to paying taxes on that income?
The situation that you just described, yes, it would be taxable, and all cash they received would be taxable.
Yeah, I think that gets very tricky because the IRS essentially looks at all income as taxable unless it's specified as not taxable.
Right.
And so where you might be able to say, well, this isn't really taxable income is like you said, Nancy, if it's clearly a gift, the IRS does not say that gifts are taxable income. And so you just have to really be able to kind of show that that really was a gift. And the more revenue that is, the harder that line becomes to draw.
Okay.
I
I'm
have
going to
two
give another
questions
example
related
that,
to that.
yeah. Go ahead, Bing.
You know, neighborhood associations do fundraisers like cleanups. And so we take money in and in our case, we do a joint with another neighborhood association and we split up the proceeds. And then we tell people if they want to have a tax deduction, do the donation through Southeast Uplift's fiscal sponsorship. And the other question I have is there a threshold for the IRS to be taxable, you know, and what is it? Because most of these are low amounts, less than like $2,000 a year.
Well, so C corporation, there's no threshold. C corporations are required to file even if they have a loss. So, am I answering your question, Bing?
If they're
So
just a domestic nonprofit, how does that apply? If they don't have tax exemption, they're a domestic nonprofit that's fiscally sponsored, but they get, say in Bing's example, $2,000 worth of like people that are like, here, I'm just donating $10 or $15 to the community cleanup.
Well, so nonprofit organizations that are not tax exempt cannot really receive donation, technically. I mean, they might be calling it donation, but that's really not a way to give money to organizations. I think they should funnel everything through Southeast Uplift. Sorry, I wasn't prepared for this type of situation, but yeah.
well, something that we've been doing for many years, except for during COVID.
So what I'm more interested in, and I don't know if you have this information handy, or maybe we can talk offline, but when you apply for a federal tax ID number, you have to let the IRS know what type of organization or entity you are. And then they send you a letter saying, here's your tax ID number. We expect you to file such form starting this year or next year. Do you have that form? Thing? But we can, well,
No, we never have to do a federal filing.
So we'll talk more about the other filing requirements, and I think there are some questions about the federal tax ID numbers and ID numbers and things like that. But we can, is that on the next slide, Blaine?
That's gaming.
Yeah, or maybe 2 slides later.
So can I just sort of just summarize, like, if an organization that is fiscally sponsored by Southeast Uplift does community events where they get donations, would your advice be to just err on the safe side and just make sure that those funds go through Southeast Uplift, and that if people want a tax receipt, they get one, but that those, to ensure that they're not having to then claim that income and pay taxes, that they should just run it through their fiscal sponsor?
Right, yes.
Okay.
Yeah, I think that's also safe from the sense that you don't want to really be seen as soliciting donations as a non-tax exempt organization. And so, while technically anybody can give anybody money, that line becomes a little blurry when you're a quasi tax exempt organization, but not funneling it through the fiscal sponsor. So doing it through the fiscal sponsor avoids any kind of complications around that.
Thank you.
Hope I didn't create any confusions here, but technically any money, you can't really gift money to a corporation. So that's why any money that's received by non-tax, non tax-exempt organization is taxable, technically. Okay. Blaine, I think the slide is missing the one about the tax ID numbers. There are questions about tax ID numbers. Sorry, we're missing a slide here.
I do remember seeing that.
Yeah. We're missing a slide here, but yeah.
It might show up later. Maybe it just got out of order.
So there's a question about federal tax ID number, and there are several different names for it. Federal tax ID number, FEIN, EIN, employer ID number, TIN, tax ID number. They all refer to federal tax ID number, and it's a 9-digit number. It's a 2-digit followed by dash and 7 digits. So, and you can apply online, and we have a link at the end again by filling out a form called SS4. And again, you fill out the application and let them know what type of entity you are. And pretty much within a few minutes, they'll issue a federal tax ID number to you with your name and address and things like that. And a few days later, you'll receive a letter from them confirming what you've done. And in that letter, will also say, we expect you to file X, Y, and Z tax returns going forward. That's the normal process. I'm not sure what's happened with the neighborhood associations that apply for tax ID numbers, and as a nonprofit but not tax exempt. So that's an unusual case, but typically you receive a letter, IRS letting you know what type of returns they expect to see from you. So that's a federal tax ID number. And also there's a Oregon employer ID number called BIN, business ID number. That's Oregon, but you need that number only if you have payroll. If you don't have payroll, you don't need that. So Oregon business ID number is necessary if you have employees. And these are the things that your payroll processor will ask for when you, oh, Stephanie's laughing.
Well, we're just a little teeny tiny organization. We barely exist, let alone have a payroll processor. So anyway, sorry. I'll stop the audio.
If you have city and county business tax, then there will be a city and county business license number. I think there was a question about business license, and that's only if you have taxable income within city and county. So those are the ID number related discussions. Sorry, our slide is missing.
I think the other thing on that slide was the 1023 and 1024. Do you want to talk a little bit about that?
Oh, yes, thank you. Let's say you have all your requirements, you incorporated in the state of Oregon, you have bylaws drafted by lawyers, and you have everything ready to go, and then you are ready to file for a tax exempt status. So there is a form, online form called 1023EZ. And some organizations are able to file 1020EZ online, and there's about 30 questions that you have to answer before you determine whether you are eligible to use 1023EZ, or if you're not eligible to use 1023EZ, you have to file a paper file, a form called 1023. It's a 27-page form that requires your budgets and officers, conflict of interest policy, and all of those things. You have to gather them and provide them. And it typically takes about, from what I heard, 6 to 18 months to hear back from the Internal Revenue Service after you submit the application. But that's the application necessary for you to obtain tax exempt status as 501c3. There are other forms like 1024A for 501c4s and 1024s for about 10 different types of 501c organizations. But for you, it's 1023 EZ or 1023. And in most cases, you want to hire a law firm to do this for you. Most law firms will provide the incorporation documents, bylaws, conflict of interest policy, as well as 1023 all together. And they can take care of that for you. And in most cases, you will get your exempt status and by a letter from the IRS saying, hey, we based on your application, we grant you a tax exempt status under code section, most likely 501(c)(3). And that's the letter you're going to need to provide to the county if you need the property tax exemption, or payroll processor if you need a federal unemployment tax exemption and climate tax exemption. So those are the forms. And Oregon, I think Blaine mentioned it earlier, but you also have to register with Oregon Department of Justice. Just because you register with Oregon Secretary of State doesn't mean you are registered with Oregon Department of Justice. There are two separate governmental agencies, and there's a form called RFC with Oregon Department of Justice. And it's a two-page form. It's a pretty simple form, but you do have to submit it because most lawyers would not include it in their packet. So that's, yeah.
A question that was submitted. So for Southeast of all the groups that we fiscally sponsor, they need to register annually with the Secretary of State's office, and they need to file a CT-12 with the Department of Justice every year. And we have a question specific to that. And it's again, the category is Oregon nonprofits that are not tax exempt. Do they have to file a federal return if the do Oregon nonprofits that are not 501(c)(3)s have to file a federal return if they file CT-12 and make less than $5,000 or $10,000?
Well, federal return needs to be filed, like I said, because they are treated as a C corporation for tax purposes. And I think I need to look into this as to whether neighborhood associations have to file CT-12, even if they don't have tax exempt status. That's something I'll have to look into. But federal corporate tax return, there's no filing threshold. You have to file if you have business activities.
So I think this gets to like, if they have income that is not going through their fiscal sponsor,
right?
And they file a CT-12, do they also have to file a federal return?
Right, yes. But I do want to look into the CT-12 filing requirements for nonprofit organizations that are not tax exempt. This is something new to me, so yeah. I'll look into it. But regardless, whether they file CT-12 or not, the entity that has a separate tax ID number that's not tax exempt, if they have any income or any money received, they do have to file a corporate tax return as well as Oregon corporate tax return. Nonprofit organizations would have to file Oregon 20 if they have taxable income. So since they don't have tax exempt status and all of their income will be taxable by the feds also to Oregon. So in that case, you'll have to file 1120 C Corp tax return as well as Oregon 20 corporate tax return.
And is there a threshold of dollar amount?
C Corp has no threshold.
Yeah, that's also assuming you're not fiscally sponsored.
Sponsored.
So,
right.
Yeah,
yes.
If you're fiscally sponsored, you're essentially exempt under another organization.
So I think there might be some confusion on my part also. If you have a fiscally sponsored organization that have their own tax ID, but they're not reporting or receiving any money or reporting any expenses under the tax ID, really those tax ID numbers would not have any business transactions because everything will be reported under SE uplift.
Right. So if a neighborhood association isn't tax exempt, they're fiscally sponsored by Southeast Uplift. Any charitable contributions to them, whether it's a grant or a donation from an individual that wants to get a tax write-off, or like a business sponsorship if they contribute to an event or something. All of that has to go through Southeast Uplift, because we're the tax exempt entity. However, if someone, puts out a jar for donations at a community event and folks put a few dollars in it and they're not expecting a tax write-off, they're just making that is just a gift. They can put that in their own bank account, but then if they reach a threshold, are they then subject to paying taxes on that income?
The situation that you just described, yes, it would be taxable, and all cash they received would be taxable.
Yeah, I think that gets very tricky because the IRS essentially looks at all income as taxable unless it's specified as not taxable.
Right.
And so where you might be able to say, well, this isn't really taxable income is like you said, Nancy, if it's clearly a gift, the IRS does not say that gifts are taxable income. And so you just have to really be able to kind of show that that really was a gift. And the more revenue that is, the harder that line becomes to draw.
Okay.
I
I'm
have
going to
two
give another
questions
example
related to that.
Yeah. Go ahead, Bing.
Neighborhood associations do fundraisers like cleanups. And so we take money in, and in our case, we do a joint with another neighborhood association, and we split up the proceeds. And then we tell people if they want to have a tax deduction, do the donation through Southeast Uplift's fiscal sponsorship. And the other question I have is there a threshold for the IRS to be taxable, and what is it? Because most of these are low amounts, less than like $2,000 a year.
Well, so C corporation, there's no threshold. C corporations are required to file even if they have a loss. So, am I answering your question, Bing?
If they're just a domestic nonprofit, how does that apply? If they don't have tax exemption, they're a domestic nonprofit that's fiscally sponsored, but they get, say in Bing's example, $2,000 worth of like people that are like, here, I'm just donating $10 or $15 to the community cleanup.
Well, so nonprofit organizations that are not tax exempt cannot really receive donation, technically. I mean, they might be calling it donation, but that's really not a way to give money to organizations. I think they should funnel everything through Southeast Uplift. Sorry, I wasn't prepared for this type of situation, but yeah.
Well, something that we've been doing for many years, except for during COVID.
So what I'm more interested in, and I don't know if you have this information handy, or maybe we can talk offline, but when you apply for a federal tax ID number, you have to let the IRS know what type of organization or entity you are. And then they send you a letter saying, here's your tax ID number. We expect you to file such form starting this year or next year. Do you have that form? Thing? But
no, we never have to do a federal filing.
So we'll talk more about the other filing requirements, and I think there are questions about federal tax ID numbers and ID numbers and things like that. But we can. Is that on the next slide, Blaine?
That's gaming.
Yeah, or maybe 2 slides later.
So can I just sort of just summarize, like, if an organization that is fiscally sponsored by Southeast Uplift does community events where they get donations, would your advice be to just err on the safe side and just make sure that those funds go through Southeast Uplift, and that if people want a tax receipt, they get one, but that those, to ensure that they're not having to then claim that income and pay taxes, that they should just run it through their fiscal sponsor?
Right. Yes.
Okay.
Yeah, I think that's also safe from the sense that you don't want to really be seen as soliciting donations as a non-tax exempt organization. And so, while technically anybody can give anybody money, that line becomes a little blurry when you're a quasi tax exempt organization, but not funneling it through the fiscal sponsor. So doing it through the fiscal sponsor avoids any kind of complications around that.
Thank you.
Hope I didn't create any confusions here, but technically any money, you can't really gift money to a corporation. So that's why any money that's received by non-tax exempt organization is taxable, technically. Okay. Blaine, I think the slide is missing the one about the tax ID numbers. There are questions about tax ID numbers. Sorry, we're missing a slide here.
I do remember seeing that.
Yeah. We're missing a slide here, but yeah.
It might show up later. Maybe it just got out of order.
So there's a question about federal tax ID number, and there are several different names for it. Federal tax ID number, FEIN, EIN, employer ID number, TIN, tax ID number. They all refer to federal tax ID number. And it's a 9-digit number. It's a 2-digit followed by dash and 7 digits. So, and you can apply online. And we have a link at the end again by filling out a form called SS4. And again, you fill out the application and let them know what type of entity you are. And pretty much within a few minutes, they'll issue a federal tax ID number to you with your name and address and things like that. And a few days later, you'll receive a letter from them confirming what you've done. And in that letter will also say, we expect you to file X, Y, and Z tax returns going forward. That's the normal process. I'm not sure what's happened with the neighborhood associations that apply for tax ID numbers. And as a nonprofit, but not tax exempt. So that's an unusual case, but typically you receive a letter, IRS letting you know what type of returns they expect to see from you. So that's a federal tax ID number. And also there's a Oregon employer ID number called BIN, business ID number, that's Oregon. But you need that number only if you have payroll. If you don't have payroll, you don't need that. So Oregon business ID number is necessary if you have employees. And these are the things that your payroll processor will ask for when you, oh, Stephanie's laughing.
Well, we're just a little tiny organization. We barely exist, let alone have a payroll processor. So anyway, sorry. I'll
okay.
stop the audio.
If you have city and county business tax, then there will be a city and county business license number. I think there was a question about business license, and that's only if you have taxable income within city and county. So those are the ID number related discussions. Sorry, our slide is missing.
I think the other thing on that slide was the 1023 and 1024. Do you want to talk a little bit about that?
Oh, yes, thank you. So let's say you have all your requirements, you incorporate it in the state of Oregon, you have bylaws drafted by lawyers, and you have everything ready to go, and then you are ready to file for a tax exempt status. So there is a form, online form called 1023EZ, and some organizations are able to file 1020EZ online, and there's about 30 questions that you have to answer before you determine whether you are eligible to use 1023EZ, or if you're not eligible to use 1023EZ, you have to file a paper file, a form called 1023. It's a 27-page form that requires your budgets and officers, conflict of interest policy, and all of those things. You have to gather them and provide them. And it typically takes about, from what I heard, 6 to 18 months to hear back from the Internal Revenue Service after you submit the application. But that's the application necessary for you to obtain tax exempt status as 501c3. There are other forms like 1024A for 501c4s and 1024s for about 10 different types of 501c organizations. But for you, it's 1023EZ or 1023. And in most cases, you want to hire a law firm to do this for you. Most law firms will provide the incorporation documents, bylaws, conflict of interest policy, as well as 1023 all together, and they can take care of that for you. And in most cases, you will get your exempt status and by a letter from the IRS saying, hey, we based on your application, we grant you a tax exempt status under code section, most likely 501c3. And that's the letter you're going to need to provide to the county if you need the property tax exemption, or payroll processor if you need a federal unemployment tax exemption and climate tax exemption. So those are the forms. And Oregon, I think Blaine mentioned it earlier, but you also have to register with Oregon Department of Justice. Just because you register with Oregon Secretary of State doesn't mean you are registered with Oregon Department of Justice. There are two separate governmental agencies, and there's a form called RFC with Oregon Department of Justice. And it's a two-page form. It's a pretty simple form, but you do have to submit it because most lawyers would not include it in their packet. So that's, yeah.
A question that was submitted. So for Southeast of all the groups that we fiscally sponsor, they need to register annually with the Secretary of State's office, and they need to file a CT-12 with the Department of Justice every year. And we have a question specific to that. And it's again, the category is Oregon nonprofits that are not tax exempt. Do they have to file a federal return if the do Oregon nonprofits that are not 501c3s have to file a federal return if they file CT-12 and make less than $5,000 or $10,000?
Well, federal return needs to be filed, like I said, because they are treated as a C corporation for tax purposes. And I think I need to look into this as to whether neighborhood associations have to file CT-12, even if they don't have tax exempt status. That's something I'll have to look into. But federal corporate tax return, there's no filing threshold. You have to file if you have business activities.
So if I think this gets to like if they have income that is not going through their fiscal sponsor,
Right.
and they file a CT-12, do they also have to file a federal return?
Right, yes. But I do want to look into the CT-12 filing requirements for nonprofit organizations that are not tax exempt. This is something new to me, so
Yeah.
I'll look into it. But regardless whether they file CT-12 or not, the entity that has a separate tax ID number that's not tax exempt, if they have any income or any money money received, they do have to file a corporate tax return as well as Oregon corporate tax return.
Okay.
Yes.
It's an interesting concept because most of the organizations we file for, naturally, they're filing Form 990 as well. So
Yeah.
we don't really see the side of it where might have a corporation that's not filing a 990 because it doesn't need to, but it does need to file a CT-12. So that is an interesting situation.
And I'll share that we receive also guidance from the Center for Nonprofit Law. And so it's been the history with our fiscal sponsorship program, our relationship with the city, and also information from the Center for Nonprofit Law that CT-12s do need to be filed. Those are the two. Any domestic nonprofit corporation has to file a CT-12, which just talks about your fundraising.
Nancy, so do most of your fiscally sponsored entities have their own tax ID number and they're set up as nonprofit corporation, but not have the tax exempt status?
Most of them are not tax exempt. All the ones that we fiscally sponsor are not tax exempt.
Right.
Whether they have their own tax ID number, I'm not sure.
Okay.
But they may be registered with the Secretary of State as a
Yeah,
nonprofit.
as
an
part of our
entity.
fiscal sponsorship program, annually, we need to make sure that they have both of those state registration and the CT-12.
Okay, there's a comment from Machu that says most do have their own 501c3 status, or most of them have federal EIN, but some have, sorry, the message just disappeared on me. Most do have their own federal EIN. A handful have C3 status with IRS. If they have 501c status, why would they go through you?
No, I think it was the other way around, that most have an EIN and only some have tax exempt status.
Oh. Okay.
So, like, for example, excuse me, we fiscally sponsor an organization that has like fee for service contracts. Those contracts, the income that they raise from that business agreement, that's taxable income. And they have their own EIN, they have their own bank account. It's not charitable funds when they are paid for their services. That is something they have to pay taxes on. And it doesn't come through Southeast Uplift.
Okay. I think that's what we're saying earlier. If they have federal tax ID, but they don't have tax exempt status, any money that comes through their bank account will be taxable. Yeah, okay.
Yeah, okay.
Yeah,
I think that makes it clear.
Okay.
You want to talk about lobbying, Sang?
Sure. I think we've skipped a gaming slide.
No, you're right. You're right.
Yeah,
gaming.
Yeah. Well, gaming, if you do any type of fundraising and have bingos and raffles, I think are more common. And if you hit certain threshold, you have to register separately with Oregon Department of Justice for gaming license. So we also have a link to Oregon Department of Justice's website about the gaming. So I just thought I'd bring it up because for whatever reason, this is not widely known information. So that's gaming.
So would a raffle fall under that category?
Yes.
It's a great question.
Any game of chance is considered gaming
Okay.
for DOJ, also IRS.
These days, I think you're right, Nancy. The raffle is the very common one that we see organizations do at events.
And that's only if money is exchanged. If it's just like it's free, have a ticket, win a prize, no one's buying the tickets. Does that matter?
If it's free, I guess that's not a game of chance. They're not buying into it.
Right.
Yeah.
Yeah.
Okay.
This is interesting. I would
No
assume
money
not.
exchanged. Yeah.
Right.
Yeah. Huh. Okay. A statement of functional expenses. This is something that a lot of organizations um, have difficulty with. And when any organizations, nonprofit or for-profit or tax exempt, when they talk about expenses, they think of it in terms of their natural category. So what they're for. For example, if you pay someone to do work, you call that payroll expense. You pay the government tax, you call that payroll tax. You pay your landlord, you call that rent. So that's what's called natural category. But 501c3s and 501c4 lobbying organizations, you also have to break down your expenses into functional category. There are three functional categories: program, management, and fundraising. So if you, in the old days, when you watch late night TV programs, they used to have commercials where they say, hey, we're trying to help out these homeless children in a foreign country. If you give us $1, we'll make sure we spend 80 cents for the kids. So they're saying 80% of their resources are going into their programs. So that's what we're talking about, program expenses. And when Nancy calls me and we talk about the 990s and board meetings and things like that, she's managing the organization. So we'll call that management expense. And obviously you have fundraising people who do fundraise. Then you'll have to categorize their payroll as fundraising expense. So this is something that whether you file 990 or 990EZ, although 990EZ doesn't have a separate page where you have to list your expenses by natural category and functional category, you do have to let them know, report on the 990 how much of your expenses are related to running your program. So it is a pretty important concept. And also, well, there are several important reasons why. One is your potential donors and grantors will look at your 990 or your financial statements or the report you submit and go, okay, how much of their resources are going into their program? And there's no right or wrong answer. Well, there is a wrong answer. If you spend less than 30% of your expenses in program, then DOJ will bug you and they'll come and start auditing you and things like that. So you don't want to go there. But in most cases, on average, really rough average, is about 70% program, 20% management, and 10% fundraising. That's pretty common percentages. But homeless organizations, food bank, and organizations like that, they have higher program expense because they have a lot, they get food donated, they distribute food, they're all considered program expenses. The larger the organization, the higher the program percentage because they can leverage their management more. So something to keep in mind, this is an important thing. And also when you go to GuideStar, Charity Navigator, and websites like that, I think they rate you based on how effective your organization is, and they determine that by looking at the program. We have it on the slide, program spending ratio. So it is, some categories are pretty easy to break down into functional categories. For example, if you have a dedicated employee who does only fundraising, then all of our payroll, all of our benefits, payroll taxes would be considered fundraising. So that's easy. But think about in the case when you buy a box of paper, and you print management reports for the board of directors, and same box of paper you use to print fundraising flyers and things. So you'll have to have a pretty detailed system to track all your expenses to see where they're going. So when it is not practical to track all those expenses, the next best thing to do is look at your employee's timesheet and say, okay, what percentage of our time are our employees spending running programs, management and fundraising, and you can use those percentages and apply to other expenses like rent, utilities, internet, and office supplies. Otherwise, you'll have to hire 5 extra people just to track your expenses, which you don't want to do. So something to consider as you look at your expenses. Again, even if you file 990EZ, you do have to report on your IRS form what percentage of the amount of program expenses you are spending. So I think I went over the next slide while I was talking, Blaine. Sorry.
Yeah, I think
yeah.
This is a good categorization of the different functions you were talking about.
Right. So okay, so a lot of times clients come to us and expect us to prepare their functional expense statement. We do prepare them, but the input has to come from the client. That's what this is saying, that we don't know the expense allocation within your organization. So when you hire CPA or accountant to do your 990s or 990EZs, you'll have to let them know the cost breakdown. So that's what this is saying. I think we can take a pause here also and
see if we have other questions.
Yeah, more questions. Nancy, I'll get back to you really about the non-profit organizations that are not tax exempt, but registered with Oregon Secretary of State and have federal tax ID number, their filing requirements. I'll get to the bottom of it and send you some information about them.
Thank you. That'll be great. If there aren't any questions, or as folks are thinking of one, there was one more that was submitted on with the registration, and it might be one that I might be able to answer, but I'll put it to the both of you first. It was when do nonprofit, oh wait, no, sorry. Do 501c3s need to buy their own insurance, or can they receive insurance through another organization like Southeast Uplift?
Yeah, and I think, Sang, did you want to?
Well, so, I think this really has to go to the insurance agent or broker.
Yeah.
But, again, my understanding is if you have a separate tax ID and you're set up as a separate company, then you may not be able to go through another organization's insurance. That I don't know for sure. So that's something.
Yeah, I can share what I've heard from our insurance broker, because we provide insurance for most of the neighborhood associations that that we support, including a couple that are 501c3, but a couple that are 501c3 that we do not provide insurance for. The ones that we don't provide insurance for own property. And so I think from the insurer's perspective, they strongly discourage a 501c3 organization getting their insurance from someone else that is pooling and it has many additional insured under the policy, because if you own a property, you want to make sure you're fully supported through your insurance policy if something goes wrong with that policy, not sharing that risk with many other organizations. But if you don't own property, currently our insurance broker encourages nonprofits to have their own insurance, but they will provide them with insurance under our policy. But I can't say that the insurance company will continue to be willing to do that. So I think some organizations may be wondering, well, should we just get our own 501c3 status, but could we still get insurance from Southeast Uplift? At the moment, the answer is yes, unless you buy property. But we just can't guarantee that the insurance company may say, well, actually, no, you should, as a C3, be on your own and cover that yourself. So,
and Nancy, I think this is something I would encourage attendees or organizations that have questions about this to run it by their legal counsel, because one of the reasons why you set up a separate legal entity is for liability protection. So I'm not sure how that comes into play when you have insurance policy through another organization, but you're a separate legal entity. So, yeah.
Yeah.
Okay. Shall we move on?
Let's do it. And I think that was all the questions that were submitted with the registration. So I feel like we've covered them. And then from here on out, it's folks in the room and the questions they have.
Excellent. Thanks, Nancy and Sang. So shifting gears a little bit here, we've talked about IRS form requirements and filing requirements and what it looks like to become a 501c3 or tax-exempt organization. We're going to look a little bit now at what it takes to stay a 501c3 and specifically a public charity. So we'll talk a little bit about what a public charity is as opposed to other kinds of charities and what kind of goes into maintaining that status. So the default status for any 501c3 tax-exempt organization is what's called a private foundation. And so the IRS essentially says, unless we tell you otherwise, you are what's called a private foundation. And so a private foundation is essentially, it's still an exempt organization from income taxes under 501c3. But it's a little bit more restricted than an ordinary public charity in the sense that it's more designed to be managed and controlled by a few select individuals. Oftentimes you'll see these in family foundations. So especially very wealthy people like to go out and create these foundations where they can still have a semblance of control over where the money goes and who they give this money to. It's still being used for charitable purposes, but it's not necessarily being funded by the general public and supported by the general public. And so while they are exempt from income taxes, they are subject to a tax on net investment income. And so they also file what's called a 990 PF. And so it's a different type of 990 specifically for private foundations. One other key difference is that private foundations often find it difficult to get grants from other nonprofits or government agencies. Many of them just won't give to private foundations because they're looking for the funds to be spent towards the general public, not given away via grants by another organization. So that's what a private foundation is. Again, this is the default status, but most organizations that are seeking 501c3 status are really looking to become what's called a public charity. And so there are many different kinds of public charities. In fact, the 990 has an entire schedule dedicated to just this, with a long list of various statuses you can have. Churches, schools, hospitals, medical research organizations, those are all examples of public charities. But most organizations fall under one of two statuses. For short, I'll call them 170B and 509A2. Those are the two code sections that govern these different organizations. And so both of these organizations have a lot in common. They're designed as statuses for the IRS to say these organizations are broadly supported by the general public in some way. One of them more supported based on the contributions they receive. Another one is more supported by the activities that they conduct. So we'll look at the first one, 170B. This is an organization, a 501c3 organization, that receives most of its support from contributions that are given by the general public at large. And so this can be either individuals or corporations that are giving, small amounts individually, or it can be governmental units and other nonprofit public charities that are also granting funds to these organizations. Both of those amounts can contribute to public support. But the IRS looks at this and they do what's called a public support test on these organizations. And so they will look at contributions from any one entity or individual over a 5-year period. And if the amounts from that one individual or organization exceed 2% of the total support that the organization has received over that same 5-year period, they won't count the amount beyond that 2% towards public support. And so you end up with this fraction, right, where the top is public support, which is being limited to a certain amount, that 2% threshold. And then you have a number at the bottom, which is all support that the organization has received over that 5-year period. And the percentage that you get from that is called your public support percentage. So organizations that follow this first test here for public support, what they really want to look out for is receiving large amounts of money from individuals or private companies, but just a couple of them. And so, like, if one individual or 5 individuals are really giving you a majority of your funds, you're going to run into issues passing this public support test. And so if you do that for too long, you run the risk of the IRS saying, well, you're not really a publicly supported organization. We're really going to recharacterize you as a private foundation. And so while that doesn't jeopardize your tax-exempt status, it does mean that you're going to have to file that 990 PF, and you're going to have more difficulty obtaining government money. It's kind of a different realm to navigate. And most organizations, I think, find public charity status to be more ideal. And then on the other hand, we talked about the first status, which deals with contributions. The second status is really more focused around mission-related income. And so these organizations, oftentimes we see things like theater companies, maybe performing arts companies. They put on performances. They're still tax exempt because they're focused on providing a public benefit, but they receive money in the form of exchange revenue. So somebody buying a ticket to go see a show at the Oregon Symphony, for example. This revenue still counts as public support for these organizations because it's revenue that the general public is providing for them to carry on their activities and provide the benefit that they're providing to the general public. However, there is still the same limitation that comes into this, which is that any excess revenue that's coming from the same individuals, either excess donations received, this one is from the organization's inception. So this becomes kind of less and less of an issue as the organization becomes older. But also excess revenue over the 5-year period we talked about before, that's from exchange transactions, also gets limited in the same way that contributions get limited on the other tests. So this is a very nuanced area of tax-exempt organization filing. And it's not one that you really need to get a perfect handle on as a board member or as an executive director. But the key takeaway for this is if you are filing a 990EZ or a 990, you will have to file these public support tests on 990 Schedule A. And you will just want to keep in the back of your mind that if you're filing that first test, you're going to want to just watch out for large contributions that are amassing from the same few individuals, and just keep an eye on that public support percentage on Schedule A. And then if you're on the second test, you just want to look out for this one's harder to get concentrations, but it would be like if you're receiving your mission related revenue just from a few businesses or individuals, you could fall into the same trap. So I think that's all we have on public support. Just kind of things to keep in mind if you are a 501c3 organization that is a public charity, watching those statuses. Note, if you file 990 in, you're not required to complete Schedule A, and so you're not needing to pass this test on a yearly basis. However, if you do all of a sudden become required to file 990EZ or 990, the regular full form, you do still have to go back and complete the other sections of this test. So you will need to go and fill out the whole 5-year period when you're filing one of those other forms. So I know that's a lot of heavy content. Honestly, this is something that even looking at these forms and preparing these forms year after year, it just takes a long time to grasp this test. So if anybody has any questions on this, we can handle them now, or feel free to email Sang and I after with these questions, and we can always address them then.
That would be great if you could both put your email in the chat for folks that may have any specific questions. That'd be great.
And a couple more discussion topics that you should be aware of if you're a 501c3 organization. One is lobbying, and the other is political activities. Blaine, can you move it forward? So lobbying, there's various definitions, and there are exceptions to the rules and things like that. So I'm oversimplifying, but if your activities are considered attempting to influence legislation, is considered lobbying. And 501c3 organizations can do some, not a lot. And the code section doesn't really define any kind of threshold. It just says you can have insubstantial amount, and there are ways to get around it. But if you're gonna get into a lobbying area, I think you should talk to your accountant or CPA before you do that. So that's lobbying. And then political activities. So pretty much, again, similar to lobbying, various definitions, and there's a lot of things that are considered political that's not really political for 990 purposes. But bottom line is, if you're trying to get someone elected to a public office, then you are having a political activities. And 501c3s, you cannot have any political activities at all. So in order for you to retain your tax-exempt status, don't get into political activities. That's all we have on that slide. But again, if you there are things that you can do and you cannot do. So if you are thinking about doing this, again, you should talk to your CPA about it before you do it. Nancy?
Yeah, I just wanted to share, because we're headed into an election. We have a whole new city structure that's coming up with, city councilors that are elected to districts and everything. And I'll use an example of something that is okay to do. For example, we hosted a mixer with all of the candidates for mayor. And it was just a meet and greet for the community to talk to them. But we didn't advocate that you vote for any of these particular candidates. And so if your organization is planning to do something like that, make sure that you make an announcement. I would suggest that you do it really early and say, we do not support or endorse any of the candidates running for office. We sort of had that disclaimer at the beginning, to make sure that folks know that, we're prohibited from supporting political candidates, and that any opinions that are expressed in the room are those of the individuals who express them and not of the organization. That just kind of sets the tone to keep you out of hot water. And so I know that lots of organizations like to, as particularly neighborhood associations, may get requests from candidates to come and, speak at your meetings, introduce themselves. As long as everybody recognizes that line and doesn't say, well, how can we get yard signs to promote you or things like that? Like, you don't want to cross that line, right? You want to be completely neutral and just be a convener that is allowing them to speak to your audience, but that you're not specifically taking a position.
Thanks, Nancy.
Blaine, I think it's you bit next.
Yeah, I think there we go. So this section, I'll cover this, try to be kind of a little bit brief on the first run through, and we can kind of see if people have specific questions about this when we kind of come to the end and address those. Unrelated business income is a very large kind of concept, because it's really the IRS saying, well, sure, you're a tax-exempt organization, but we're not going to grant you the ability to go out and just compete with for-profit businesses on an unequal ground. So they want to prevent nonprofits from sort of abusing their status as a tax-exempt organization and just going out there and saying, well, we're going to start throwing up vending machines all over the place, but we don't have to pay tax on the revenue. And so unrelated business income tax really covers any item of revenue that's unrelated to the organization's mission as a whole, but that is kind of carried on for the purpose of generating supplemental income. It doesn't matter what that income is used for. And so you can't really say, well, this is unrelated to our mission, but it's also, we're going to use the funds to help our charity. The IRS does not care what you use the funds for. They're going to say, well, it's not related, and so it's then taxable. So we'll look at what each of those terms means and what types of things might fall under this categorization. So general rule for UBIT, unrelated business income tax, it has to be a trade or business. And so this has to be something that's carried on for the purpose of earning money, and not just something that's carried on for the purpose of fulfilling some other need. So you're profit motivated is oftentimes the term that's used here. It has to be regularly carried on. And so this doesn't necessarily mean it's carried on every day or every year. It's not necessarily periodic. IRS typically defines regularly carried on as the organization is putting a regular amount of its resources into conducting this activity. And so this would be like, you could have one person that out of your 20-person staff that's dedicated to doing this on a daily basis. That would be considered regularly carried on by the IRS. And then the third requirement here is that it's not substantially related to the organization's exempt purpose. So you could have activities that are profit motivated, regularly carried on. So think about, again, the example of a symphony. Both of those things are generating profit and they're carried on regularly, but they are related to the organization's exempt purpose because they're directly mission related. And so that wouldn't be unrelated business income because it's not unrelated. And so the IRS says that these three things constitute unrelated business income unless a specific exception applies under IRS Section 513. And we'll look at a couple of those a little bit later. So again, this is kind of what I just summarized, but we're really saying unrelated business taxable income, that's just gross income that's from something that meets those three criteria. So unrelated business taxable income, UBTI, that's taxable income that's generated because it's an unrelated business activity. And then unrelated trade or business, And this is something, again, substantially not related. It doesn't matter what the funds are used for. If the activity is not related to your exempt purpose, according to the IRS, and it's a trader business that's regularly carried on, it's at risk of being UBIT. And then again, a trader business, something that's actually carried on for the production of income. And there's a lot of very interesting court cases that kind of get into this nuance in particular, whether or not it's profit motivated. So some of them will look at it and say, well, we haven't been making a profit. And so this isn't actually a trader business because we're not making money. And a lot of the times, most times the IRS and courts will agree that, even if you're not making a profit, you may have the intention of making a profit. So if you're carrying on this activity in a manner that suggests that your intention is to make money from this eventually, the IRS is going to say, well, this is still a trader business. It's just not a successful trader business. And so that it's still going to be subject to potentially subject to unrelated business income taxes. That being said, if you're receiving losses from this activity, you're not really at much of a risk, because you're only going to be taxed the same way a normal corporation would be taxed, which is on net profits, so net taxable income. And so if you're having an activity that is unrelated, but it's a loss activity, you're going to have to still file a return, but you're not going to actually incur any kind of actual tax on that because it's just going to be a loss. So a couple exceptions, specifically under 512 and 513. So the IRS grants a few safe harbors for things like profits from work where substantially all of it's performed by volunteers. This is often referred to as the kind of like the goodwill exception. And so you're thinking like, well, we're receiving donated income, donated products, and they're being sold by volunteers, maybe like a trade fair or something of that nature. In instances where that work is being performed by volunteers, it's not really a trader business. The same goes for where all the merchandise has been received as contributions. So it's like the thrift store exception. You're receiving products that are donated, and you're selling those because people have donated them to you with the understanding that you would then be selling them to the community. Goodwill, a great example of this. And so that really is not going to generate UBIT. And then another good example is when the business conducted by a 501c3 organization, it's being operated for the convenience of members, patients, whoever its charitable class is. This is kind of like your museum shop exception. So like a food court in a museum will most commonly fall under this exception because it exists really only for the benefit of people attending the museum. It's not designed to just bring in customers from outside the museum and turn a profit. It's there because people visiting the museum get hungry, they want a place to eat. Gift shops, the line gets a little grayer. Oftentimes gift shops will hide under this same thing, saying, we're just here because we want people to kind of have mementos, have things to remember the organization by, or they'll say we're here to promote education. The stuff we're selling, it's science kits, it's postcards, it's not something that's really unrelated. There's kind of been mixed bags here as the IRS is concerned with organizations that are operating gift shops. And so that's kind of a more nuanced area, but the same kind of logic tends to be the one that people go to, which is when a trader business is conducted just to benefit its charitable class, it's not considered UBIT. So something that we won't cover in detail, but something to know, a few years ago, the IRS came out with what's called the fragmentation rule. This is really saying you can't just look at an activity on its whole and say, well, aspects of this might be unrelated, but the whole activity is really considered exempt because it's part of an exempt activity. A great example of this is publications by like in a monthly journal, but where advertisements are included in this. So advertising is sort of the gray herring when it comes to the UBIT realm. So advertising, probably the most common type of UBIT that we see. And so IRS is always going to say the sales of advertising is not going to be considered to be related to your organization. And so whether or not your publication is an exempt activity, and so maybe it's part of your mission, they're still going to look at that and say, sure, but the advertising element, the sales of advertising in your journal is not part of that same activity. And so they're going to pull that out and call that portion UBIT. And so some examples where there's kind of not really a substantial relationship. We talked about the museum shop. So in this instance, they're going to look at the fragmentation rule and say, well, some of the things you're selling in there, those may be related. So think OMSI selling those little science kits that they have in their gift shop. The OMSI can say, well, sure, the sale of science kits directly relates to our mission because it encourages education. It's an educational product. But then selling the other things in there, like maybe there's some kind of a game, and they're going to look at that and say, well, the playing of a game is not really educational. It doesn't really fit your same mission. And so each line of product in a museum shop is going to be considered separately. Another thing is kind of the sale of mailing lists. You see this a lot lately, especially with kind of digital data becoming so common. Whether or not you obtained the mailing list for an exempt purpose, selling a mailing list to advertisers for profit is probably not going to be considered related to your organization. So again, that gets very nuanced. We won't cover any of those in too much detail, but I did want to cover a few of the more common examples of what constitutes unrelated business income. Advertising is definitely the most prominent. The IRS is really, they draw a very, very bright line and kind of classify any type of advertising as unrelated. And so this has even gone to the point where you might have maybe you're a nonprofit that specializes in raising awareness for a medical issue. And so you have advertisers that put into your newsletter products that treat that specific medical issue. And the IRS generally will still look at that and say, well, you know, even if this is directly related to the people who are reading that journal, still the aspect of advertising their products, specifically endorsing those products and recommending that people buy them is not part of your mission. So advertising in almost any light will be seen to not have a substantial relationship to the organization's exempt purpose. And then rental income. Generally, rental income is not considered related in most cases. It can be potentially related, but for most organizations, it's going to be considered unrelated. However, it is specifically excluded by the IRS from the definition of UBIT. However, the IRS does say that if you have rental income, but you have property that's been financed by debt, and so most oftentimes we think of mortgages, right? Mortgages that are covering properties. That income is no longer excluded from UBIT. And so it may be subject to UBIT if other circumstances other tests are not met. And so there are some exceptions to this. The IRS says if substantially all of the property that you have is being used for your exempt purpose, so maybe you're, you know, a dance theater and you're renting out the theater for 10% or 5% of the time. The IRS says if 85% of the use is related to your exempt purpose, then the UBIT portion is insubstantial and you don't have to report it at all. So none of it gets characterized as unrelated. There are also some other circumstances that kind of can affect this. But I think the big takeaway with this is really if you're doing rental activities that are not related, so you're not renting to, you know, low-income housing people and you're a low-income housing organization, you know, it's something that's unrelated and it is more than that insubstantial 15% threshold, you're going to want to kind of look at this and reach out to your tax advisor and kind of consult them and see if you're having issues here. And then this is kind of what we just talked about, the 85% threshold. The mortgage property acquired for exempt purpose use within 10 years. This is one that I feel like we don't run into quite as often because this has to be, this is a very, I don't know, Sang, have you ever run into this? Yeah, I think this has to be like it was designed, I think, with low-income housing in mind. But it's a very specific code section. Mortgage property acquired by bequest. This is looking to say, well, an organization received this property and it was already encumbered by a mortgage, but they didn't actually take out the mortgage and finance this property by debt. They just received it and received the mortgage as a part of that. So that's going to be excluded from UBIT just because of the premise that property, it wasn't really debt financed. It was just debt. It was acquired with existing debt. So there are some nuanced situations where debt financed income may be not subject. But I think, again, the key takeaway is if you have rental income and you have debt, we want to look a little closer at this. And yeah, again, this is more on kind of the gifting. I don't think we really need to get too much into this. So other things that are excluded under Section 512, dividends, interest. This is basically your investment income exception. So the IRS is going to say, sure, the receipt of dividends or interest, even interest from your bank account, technically this is not related income because it's not obtained as a part of your exempt purpose as a tax exempt organization. However, they're not going to tax you on it because they're saying this is just passive income. Again, debt financed investment income is going to cause you trouble. You don't see this often, but this would be like if you took out a loan to purchase a stock, for example. I've never seen that. It could happen. If it did, you would also kind of run into the same debt financed issue that rental income has. Royalty income is also specifically excluded, although you do want to be careful that this is passive royalty income and not royalty income that rises to the level of a trade or business. I'm guessing this is probably kind of beyond the purview of our conversation, but just know that generally royalty income is going to be exempt. And then the sale of investments, this is like stock sales. Oftentimes you'll see people get donated stocks. And so, of course, they have to sell them. The gain on that sale is not going to be considered UBIT. It's also excluded. And that's kind of UBIT in a nutshell. Again, UBIT's a very broad area. We could probably go on and on about this. But does anybody have any questions on that or anything else that we've talked about so far today?
Give folks a minute to digest and consider.
Blaine, can you move it to the next slide? So we thought it would be good for us to include some reference materials for you. So there's a link to Oregon Secretary of State where you can do a search if you need to. Department of Justice website links, and also IRS. One is where you can look at your tax exempt status. The other is where you apply for federal tax ID number online. And then IRS publications that would be helpful or useful if you have questions are listed there. And 1771, I think, is the one that you might want to take a closer look at because there are very specific languages about what to say in thank you letters and what not to say. And if you at auctions and fundraising events, if you provide goods and services, what to say, what not to value, and things like that. Pretty important information is in that IRS publication 1771. You can go to IRS's website and and search for these publications. Also, you can Google them as well.
They usually come up pretty. There's not a lot of
Yeah.
things called publication 1771, so good chance you'll find it.
Yeah.